History doesn't repeat, but it sure does rhyme. And right now, Bitcoin is singing the exact same tune that sent it crashing from $93,000 to $60,000 just months ago. If you missed those warning signs before, you cannot afford to miss them again. Welcome back to the channel where we cut through the crypto noise and give you the data that actually matters. I am your host, and today we're diving deep into a pattern that has me genuinely concerned about Bitcoin's short-term trajectory. We're going to analyze the exact price action that preceded Bitcoin's 25% crash, compare it to what is happening right now, and most importantly, give you a game plan for what to do next. So here's what we know. Bitcoin recently hit new all-time highs around $97,000, and since then, we've seen a series of lower highs and weaker bounces that look eerily familiar. The pattern I am talking about happened between November and January, and it is characterized by three key elements that we're seeing again right now. First, we have what I call the false strength rally. This is when Bitcoin pumps hard, everyone gets excited, but the volume and conviction behind the move is actually decreasing. Back in November, we saw Bitcoin hit that 93,000 high, but if you looked at the on-chain data, you could see that long-term holders were actually distributing, not accumulating. Second, we have the buy the dip fatigue. This is crucial. When Bitcoin started pulling back from those November highs, every dip was bought aggressively at first. But as the weeks went on, each bounce got weaker and weaker. The market was running out of buyers willing to step in at higher prices. And third, we have what technical analysts call a bearish divergence in momentum indicators. While price was making higher highs, the RSI and other momentum oscillators were making lower highs, signaling that the upward momentum was dying. Now, if you're finding this analysis valuable so far, smash that like button. It genuinely helps more people see this content, and I spend hours researching these patterns for you. Let us dig into the data. During the November to January period, we saw Bitcoin's 30-day moving average cross below the 50-day moving average on December 15th. Historically, this crossover has been a reliable signal for deeper corrections in Bitcoin. And guess what? We're seeing the exact same setup forming right now. But here's where it gets really interesting. The options market is telling us a story that most retail investors are completely missing. The put-call ratio for Bitcoin options has been steadily increasing, meaning professional traders are betting on downside moves. This isn't just speculation, these are sophisticated players with serious money on the line. We're also seeing some concerning signals from the derivatives market. The funding rates on perpetual futures have turned negative, which means traders are paying to short Bitcoin rather than go long. This shift in sentiment typically happens before major corrections, not after them. Now, let us talk about what happened during that November to January crash. Bitcoin went from $93,000 to a low of $59,800, that's a 35% drop. But here's the thing that most people don't realize, the warning signs were there for weeks before the actual crash happened. Fun fact, 80% of you watching aren't subscribed yet. If you want to stay ahead of these market moves instead of getting caught off guard, hit that subscribe button and turn on notifications. I promise you'll thank me later. So what are the market implications of this pattern repeating? First, we need to understand that Bitcoin is no longer just a retail-driven asset. Institutional players now control a significant portion of the supply, and their behavior is different from retail investors. When institutions decide to take profits, they don't do it all at once like retail traders. They spread their selling over weeks or even months, creating these slow, grinding downtrends that exhaust buyers. This is exactly what we saw during the November-January period, and it is what we're starting to see again now. The second implication is about market structure. Bitcoin's correlation with traditional risk assets has increased significantly over the past year. This means that any major sell-off in stocks or a shift in Federal Reserve policy could trigger a much sharper correction in Bitcoin than we've seen in previous cycles. We're also seeing some interesting dynamics in the spot Bitcoin ETFs. While inflows have been strong overall, we've started to see some distribution from these funds in recent weeks. This is significant because ETF flows are often a leading indicator of institutional sentiment. The third implication is about market psychology. When a pattern repeats this closely, it often becomes a self-fulfilling prophecy. Traders who lived through the November-January crash are now watching for the same signals, and their actions can actually accelerate the very correction they were trying to avoid. So what does this mean for you as an investor or trader? First, don't panic, but do pay attention. The market is giving us clear warning signs, and smart money managers use these signals to adjust their positions before the crowd catches on. If you're a long-term holder, this could actually be a great opportunity. The November-January crash created some of the best buying opportunities we've seen in Bitcoin's history. If history repeats, we could see similar opportunities in the coming weeks. For traders, the key is to watch for confirmation signals. A break below the 50-day moving average with significant volume would be a strong signal that the correction is beginning. On the flip side, if Bitcoin can reclaim and hold above its recent highs with strong volume, it could invalidate this bearish pattern entirely. Here's my actionable advice. First, if you're overexposed to crypto right now, consider taking some profits off the table. You don't have to sell everything, but reducing your position size can help you sleep better at night and give you dry powder for better opportunities. Second, set clear levels for both buying and selling. If Bitcoin breaks below $75,000 with volume, that could be the start of a deeper correction. On the upside, a break above 98,000 with strong momentum could signal that the bulls are back in control. Third, don't try to catch a falling knife. If this correction does play out like the November-January crash, there will be plenty of fake-out bounces along the way. Wait for clear reversal signals before jumping back in with both feet. And finally, remember that even if we do see a correction to 60,000 or lower, Bitcoin's long-term trajectory remains bullish. The institutional adoption story is still intact, the supply dynamics haven't changed, and we're still early in what many believe is Bitcoin's biggest bull market yet. Look, I know this isn't the hopium that most crypto YouTubers are feeding you right now. But my job isn't to make you feel good about your bags, it's to give you the information you need to make smart decisions. And right now, the smart money is being cautious. That doesn't mean you should sell everything and run for the hills. It means you should be aware of the risks, manage your position sizes accordingly, and be ready to act when opportunities present themselves. The crypto market is cyclical, and corrections are a natural part of that cycle. The traders who make the most money aren't the ones who never lose, they're the ones who recognize patterns, manage their risk, and position themselves to capitalize when the market turns. So here's my final challenge for you, drop your prediction in the comments below. Do you think Bitcoin will follow the same pattern and test 60,000 again, or do you think the bulls will step in and prevent another major correction? I read every single comment, and I'll be responding to as many as I can. And if you want to stay ahead of the next market move instead of getting caught off guard, smash that subscribe button and hit the notification bell. Trust me, you'll want to be first to know when I spot the next major pattern developing. For your next video, I highly recommend checking out my analysis of why altcoins could crash even harder than Bitcoin if this correction plays out. It's linked right here, and it could save you thousands of dollars if you're holding the wrong coins right now. Until next time, trade safe and stay profitable.